Well, the markets may be in a bit of a dip, but that's not true of some sectors. We decided to cheer you up, so we are talking about hotel stocks. They're among the best performers in the past year, while the Sensex and Nifty have gained between 5 and 7% in year-on-year terms. Indian Hotels is up 54% on the year, Lemon Tree is up 48%, and EIH is up 25%. The hotel industry consulting company Horvath says the big story of 2022 is the rise of leisure as a vertical rivaling business. Secondly, another theme we need to discuss, Air India is placing an order for 470 planes. It appears that the hospitality industry is in for a bigger leg up in the coming years because airline and hospitality are intimately connected. To discuss the trends for 2023 in the hotel industry, I have with me, of course, the biggest of them all, Puneet Chhatwal, the Managing Director and Chief Executive Officer at Indian Hotels. Puneet, thank you very much indeed for joining us. Well, first of all, do you agree that leisure is now rivaling? It's not a subsidiary, but an independent vertical after the 2022 experience?
Absolutely. It would be fair to say that leisure across the globe and in all domestic markets has led the recovery in the sector which was demolished during COVID times. And the leisure is evolving in a very new dimension because the term bleisure was coined maybe 10, 15 years ago, but we did not see much of it. So now we see that people are combining business, leisure, taking those, building those bridges, Holy Weekend or 26 Jan weekend, and all that gets counted as leisure, but a part of that is business too.
Okay, more actual, working remotely, even that increases leisure travelers?
Yes, so a lot of people have gone back to work, to the workplace, but that option, that flexibility of working 1 or 2 days, remotely is still there, and I think that is there to stay.
Okay.
And from that as a base, leisure destinations are going to benefit.
Okay. Now, let's talk business as a vertical. How much has it come to the pre-COVID levels? Has it gone beyond? And how does 23 look?
Well, the sector is back. I think pre-COVID, 1920, all the companies that you mentioned, when they report their results as their listed companies, you can see that they are already above 1920 levels. When it comes to us, we are almost at 130% plus on RevPAR recovery. And very important here is that we have opened a lot of hotels. So they're all in a kind of a settling down, stabilizing phase. So despite that, we have around what we have reported so far is 130%, which is mainly coming through rate. And when the recovery is rate driven, the profitability increases.
Okay, 1 minute. What I was asking you is, as business as a segment, how much has it recovered for you?
Business is more than 100%. For us, it's definitely gone beyond 100. I would have said around Q2, we were at 90, 92%, but we have crossed 100% also on the business.
Okay, when we speak about the MICE segment, for instance, meetings, exhibitions, conferences, that segment, has it emerged as much as it was before?
It is emerging. It was very well compensated by increase in wedding segment. But as the G20 leadership transition plus the international travel opened up, I think a lot of people are coming to India. If you look at yesterday, the German Chancellor was there. The other African delegations were there. So there is a lot of activity happening. And I am very confident that the MICE levels will far exceed 1920 going forward. And very important, Lata, here is that the key metros, Mumbai is performing north of 80% occupancy for year to date. This is not like 1 month or 1 week or a few days. And a lot of other key markets are all above 70%. There's just 1 or 2 markets which are, sub 60. But they are operating at very high rates. So it's a very positive situation at the moment, and there is nothing that I know of today which makes me feel nervous of what's going to happen in the next 3 weeks, 4 weeks, 6 weeks. The business on the books is quite strong.
Okay. So can we talk numbers? How much could you reduce the employee to guest ratio over the last 3 years because of COVID? And therefore, if you can give us some forecasts or some targets on margins this year.
I think more than reducing employees, I think the question was the sector emerged as an efficiency champion.
Okay.
And the sector actually operates 24/7, 365 days. So you don't have so much time to, put every cost under a magnifying glass and everything that you've been doing. So it was a very normal thing, including for us. What do you stop doing? What do you start doing? And what do you do more? And what do you do less? And I think with that, in a high growth company like us, we were able to provide a platform for growth to our associates with all the new openings that happened, and the efficiency came in terms of room to staff ratio. To put a number to it, I think it would be fair to say anything between 15 and 20%.
Okay, so in that case, your margins, of course, in the quarter gone by, improved considerably. I mean, you're at 35%. Is this maintainable? Is this improvable?
It is both maintainable and improvable, because when we announce our consolidated results, it includes assets that we own outside of India, where these kind of margins are very difficult to achieve. So a hotel in New York, or a hotel in London, or a hotel in San Francisco, Cape Town, they are still not back at even 100%. So they're at 90% or 92% of what they used to be in the 1920 level. So I remain fairly confident and optimistic that next year, in Q1 and Q2 onwards, they will start contributing more than 100, like has happened on the domestic front.
Okay, so if you have to talk numbers in terms of revenues, of course, last quarter was mind-boggling. 52% growth in year-on-year revenues and 37% growth in quarter-on-quarter revenues. Are we talking like 10,000 crores very easily next year?
Our enterprise level revenue, we could say, is going to be definitely north of that number. By whether it's 15 or 20, I cannot say today, but it will definitely be at that level. But that's not the consolidated.
Yes.
That includes all the management contracts that we have, where we only report the fee income. But it's very positive, and definitely we cross that number.
Okay, and therefore, if you have to come to the EBITDA level, that as well, I think, was what? It will easily be 2,000 crores this year. Does it? I mean, you see, at 600 crores in the quarter gone by, EBITDA was up 85% year on year and 103% quarter on quarter. So it's a steaming pace of growth. What's the kind of EBITDA growth we should be reasonably?
Quarter 3, historically, and also going forward, will always be the strongest. Quarter 4 was usually the number 2. And if it maintains its number 2 position for the sector, including for us as a company, I feel if we get to 85-90% of the Q3 numbers, then we would be in a very good space. But let's see, there is still, 33 days to go.
I see, quarter on quarter is always unfair in a seasonal industry. Even year on year, 85% EBITDA growth. So obviously there were base effects as well. But still, what's a reasonable run rate?
I think reasonable run rate for a company like us, which is fast growing, we should look at a top line growth of a double-digit number, and the same number multiplied by 2, assuming a 50% conversion of incremental revenue going to the EBITDA level. So I remain that's why we have given the guidance that we have given of 33% EBITDA margin in this business cycle, knowing well that historically, 10 years ago, 15 years ago, achieving even 15 was a big thing for us.
Okay. Have you also factored in a likely rise in crew rooms? I mean, if there are 470 flights for one addition for one airline, one would assume across the industry there will be increases. So how much does crew contribute to?
It depends on the destination.
5-10%?
It will be a number that will grow to around 10% for what is airline related businesses, because we are also having a 58% market share through TajSats on all the meals or flight hospitality kitchens in the air and hospitality on the ground. So I remain very optimistic that this number is also beginning to grow exponentially. It comes at a very different rate. Positioning, but it is a confirmed business for 365 days. So each hotel, each brand needs to see how much crew allocation they need to have.
Okay. And if you can give us some idea of your expansion plans, what's the latest in terms of new properties that you will build, where, And how many more management contracts are you gunning for?
Well, that's something which has been very interesting for us. We have added more than 120 contracts to our pipeline in the last 4-5 years, and we have opened of those already 40 properties. If we take the calendar year, the 4 quarters, we have signed 2.5 agreements a month, which means 30 plus.
Yes.
We think for the financial year that number will be even higher. And we have opened 17 hotels in the calendar. At a minimum, we'll open 17 also in the financial year by end of 31st of March. Going forward, I see no change because our pipeline is 70 plus hotels. So of those, at least another 40-50 will open. And
These are management...
Almost 75% of our pipeline is based on management contracts. There is some operating leases because we changed the Ginger brand model to operating leases, and a few will be owned. In the spirit of nation building, as we've always done, putting Goa on the map, putting Andamans on the map, we're going to do that with Lakshadweep, which is a very, very important project for both us and for the nation. And we are also doing a combo hotel, a Ginger and a Vivanta in Ekta Nagar, the Statue of Unity or Kevadia. So that's at the start phase almost now.
Okay. Out of time, Puneet, but you leave us extremely optimistic about at least one sector doing exceptionally well. Markets today still a bit under the weather, but not the hotel industry. As you can see, Indian hotels, post the conversation, is rushing to up 1%. We started in the red this morning. Clearly, the investing community is enthused by what we heard. We wrap up on Bazaar on that optimistic note. Trading ideas coming up for you on Chartbusters.